Sell down or pre-placement of lending, exploring a smarter way to share credit risk. Presentation overview. What is sell down pre-placement of lending? Sell down pre-placement of lending is a financing mechanism that differs from traditional lending practices. It involves the origination of loans by a lender and then selling them down or placing them with other investors instead of holding them on their balance sheet. Mechanics of sell-down pre-placement of lending. Sell-down pre-placement of lending involves the origination of loans, followed by the packaging and sale of loans to other investors or entities. The loans can be sold individually or packaged and sold as a pool of loans. Pros and cons of sell-down pre-placement of lending. Sell-down pre-placement of lending offers a number of benefits, including the ability to diversify risk and improve liquidity. However, there are also several drawbacks to this financing option, including the potential for reduced control over the loan portfolio and a lack of transparency. What is sell-down pre-placement of lending? Sell-down pre-placement of lending is a financing option that allows banks to sell their loan portfolios to investors, freeing up capital for further lending and reducing their risk exposure. Difference from traditional lending. Sell-down pre-placement of lending differs from traditional lending practices as it allows banks to transfer the risk of their loans to investors who take on the responsibility of collecting loan payments. Types of loans. Various types of loans, such as corporate loans, syndicated loans, and structured finance loans, can be sold through sell-down pre-placement of lending. Loan portfolio. Loan portfolio valuation. Valuation of loan portfolios is based on a variety of factors, including the credit quality of the underlying loans, the interest rates on the loans, and the maturity of the loans. Loan portfolio structuring for sell down. Loan portfolios can be structured for sell down in a variety of ways, including by geography, industry, or credit rating. This allows investors to target specific risk exposures and helps banks to reduce their overall risk exposure. How does sell down pre-placement of lending work? Sell down pre-placement of lending involves the sale of a portion of a bank's loan portfolio to investors. The process involves due diligence, valuation, and the structuring of the loan portfolio. Due diligence. Due diligence is a crucial step in the sell down pre-placement of lending process. It involves a thorough review of the loan portfolio to ensure that it meets the needs of the investors and complies with regulatory requirements. Valuation. Valuation is another important step in the sell-down pre-placement of lending process. It involves the determination of the fair value of the loan portfolio being sold to investors. Due diligence, loan documentation review. The first step in due diligence is a review of the loan documentation to ensure that it is complete, accurate, and up to date. It involves a careful examination of loan agreements, financial statements, and other relevant documents. Borrower profile analysis. The next step in due diligence is to analyze the borrower profiles to ensure that they meet the investor's requirements. This involves a review of credit scores, financial history, and other relevant factors. Risk analysis. The final step in due diligence is to conduct a risk analysis to identify potential risks and assess their impact. This involves a comprehensive assessment of market trends, economic conditions, and other relevant factors. Valuation, risk profile. Analyzing the risk profile of a loan portfolio is an important factor in determining its value. This includes assessing the likelihood of loan defaults, late payments, and other factors that can affect the portfolio's overall performance. Loan quality. The quality of the loans in the portfolio is another key factor in determining its value. This includes assessing the creditworthiness of borrowers, the terms of the loan agreements, and the overall performance of the loans. Expected returns. Expected returns on a loan portfolio are also an important factor in determining its value. This includes assessing the interest rates on the loans, the maturity dates, and other factors that can affect the returns on the portfolio. Structuring investment vehicles. Structuring involves the creation of investment vehicles that are tailored to investors' needs and risk profiles. Special purpose vehicles, SPVs, are commonly used to structure investment portfolios to meet investors' specific requirements. Structuring loan portfolio. The structuring of the loan portfolio is an important aspect of the structuring process. This involves the allocation of loans to different investment vehicles based on investors' risk profiles. Advantages and disadvantages of sell-down replacement of lending. Reduced risk exposure. Sell-down replacement of lending can help reduce risk exposure by allowing financial institutions to transfer a portion of their loan portfolio to investors, thereby diversifying their risk. Increased liquidity. Sell-down replacement of lending can increase liquidity by providing financial institutions with cash proceeds that can be used to fund lending activities or other business operations. Higher transaction costs. One of the main drawbacks of sell-down replacement of lending is higher transaction costs, such as legal and administrative fees, which can reduce the financial benefits of the transaction. Increased complexity. Another drawback of sell-down replacement of lending is increased complexity, which can make it harder for financial institutions to manage their loan portfolio effectively and efficiently. Advantages: reduced risk exposure. Sell-down replacement of lending allows banks to reduce their risk exposure by transferring a portion of their loan portfolio to investors. This reduces the bank's exposure to a single borrower or sector, thereby reducing risk. Capital optimization. Sell-down replacement of lending allows banks to free up capital that is tied up in their loan portfolio. This capital can be used to expand their lending capacity, invest in new products, or meet regulatory requirements. Increased diversification. Investors benefit from increased diversification by investing in a portion of a bank's loan portfolio. This provides exposure to a variety of borrowers and sectors, reducing concentration risk and increasing diversification. Higher returns. Investors benefit from higher returns by investing in a portion of a bank's loan portfolio. The returns are typically higher than other fixed income investments or similar risk due to the liquidity premium associated with the asset class. Disadvantages: higher transaction costs. The transaction costs associated with sell-down replacement of lending can be higher compared to traditional lending practices due to additional paperwork involved in the process. Complex process. The process of sell-down replacement of lending can be more complex than traditional lending practices due to the involvement of multiple parties and the need for specialized expertise. Higher risk. There is a risk that the loan portfolio may not perform as expected, leading to lower returns and possibly a loss of capital. Conclusion: advantages for banks. Sell-down replacement of lending enables banks to reduce their risk exposure and free up capital for other investments or operations. Advantages for investors. Investors can benefit from increased diversification and higher returns by engaging in sell-down replacement of lending. Drawbacks. Sell-down replacement of lending also has some drawbacks, such as higher transaction costs and increased complexity. Risk assessment. It is essential to carefully assess the risks and benefits before deciding to engage in sell-down replacement of lending. Thank you.